Okay, so picture this. You're scrolling through your phone. Maybe it's late at night, that dangerous hour when everyone suddenly becomes a financial genius in their own head, and you stumble across this graphic. Big bold letters. The 7% rule, how your money doubles every 10 years. And there's this clean little chart showing $100,000 ballooning into like 800 grand over a few decades, and something in your chest just loosens a little, right? Like finally someone's handed you the cheat code. You start doing that math in your head. If I invest this much starting now, by the time I'm 60 I'll have, and honestly, for about 4 minutes, you feel like you've got it all figured out. I've been there. More times than I'd like to admit, actually. My name is Steve, and I spend way too much time thinking about money and why people make the financial decisions they do. Like, unreasonably too much time. It's sort of my whole thing. And one pattern I keep noticing over and over, in comment sections and in conversations with friends, and honestly in my own brain at 2 a.m., is this obsession with clean, tidy financial rules. The 7% rule being maybe the cleanest and tidiest of them all. But here's the thing, and this is what we're actually going to get into today. That number, that comforting little 7%, it's doing a lot more heavy lifting than people realize. And once you actually pull back the curtain and look at what's underneath it, the assumptions, the timing, the taxes, the stuff nobody puts in the pretty infographic, you start to see why so many people who did everything right still end up staring at their retirement account feeling confused and a little betrayed. So stick with me, because by the end of this, you're not going to look at that number the same way again. And honestly, that's a good thing. So let's start at the beginning, because I think a lot of people just accept the 7% rule the way you accept that a microwave takes about 90 seconds to reheat leftovers. Like nobody questions the fundamentals, it's just a thing you know. The 7% figure comes from long-term historical stock market returns, specifically the S&P 500, averaged out over something like 100 years, and then adjusted for inflation. So the real return, meaning what your money actually grows in terms of purchasing power, has historically hovered somewhere around 7%. Some years it's 25%, some years it's negative 30%, but smash it all together over decades and you land roughly around that number. And look, that's not made up. That's not some influencer pulling numbers out of thin air. It's grounded in real data. The problem, and this is the first crack in the foundation, is that an average isn't a guarantee. It's not even close to a guarantee. It's just a midpoint of chaos. Here's a way to think about it. Imagine you're told the average depth of a river is 4 feet. Sounds pretty safe to wade across, right? But what if that average is made up of a riverbed that's 2 feet deep in some spots and 11 feet deep in others? Suddenly, average doesn't feel like safety anymore. It feels like a trap with good PR. The market works the same way. Some 10-year windows in history returned close to 15% annually. Other 10-year windows, and I mean this sincerely, returned basically nothing, flat, or worse. If you happen to retire or need your money right at the start of one of those flat decades, that cheerful 7% average did absolutely nothing for you personally. It existed, just not for you, not when you needed it. And that's the first gut punch lesson here. Averages are for populations, not for individuals. Your life, your timeline, your money, that's a single data point, not a 100-year trend line. So when you're building your actual plan, you can't just plug in 7% and call it a day. You have to plan for the version of the story where you're the unlucky one, not because you're pessimistic, but because, hey, somebody has to be the person who retires into a bad decade, and pretending it won't be you isn't a strategy. It's just optimism dressed up as math. All right, this next part is honestly the one that wrecks people the most, and almost nobody talks about it outside of finance nerd circles. It's called sequence of returns risk, and once you understand it, you will never look at average annual return the same way again. Here's the idea. Let's say two people both average exactly 7% a year over a 25-year retirement. Identical average. Same total number of good years, same total number of bad years. You'd think they end up in the same place, right? Same math, same outcome? Nope, not even close. Sometimes not even in the same universe. If the bad years, the down 20%, down 30% years, happen early in retirement while you're also withdrawing money to live on, the damage compounds in a way that's honestly kind of brutal. You're pulling money out of an account that's shrinking, which means you're selling more shares to generate the same income, which means there's less left to recover when the market eventually bounces back. It's like trying to bail water out of a boat that's actively taking on more water than you're removing. The timing of the leak matters just as much as the size of it. But if those same bad years happen late in retirement, after your money's had years to grow first, you barely feel it. You've built up a cushion. The dip is annoying, sure, but it's not existential. Same average return, wildly different outcomes, just because of when the bad luck showed up. I think about this like ordering food at a restaurant with a group of friends and splitting the bill evenly. If you order the salad and someone else orders the surf and turf with 3 cocktails, the average spend per person is still whatever it is, but you personally got a very different experience than the number suggests. Sequence risk is basically financial life saying, the average doesn't care about your personal timing, but your personal timing determines everything. So what do you actually do with this? A few things, honestly. First, if you're getting close to retirement, or you're already there, having a cash buffer, like 1 to 2 years of living expenses sitting somewhere boring and stable, means you're not forced to sell investments at the worst possible moment just to pay your bills. Second, flexible withdrawal strategies matter more than fixed ones. If the market tanks, and you can trim your spending a bit that year instead of rigidly pulling out the same amount, you protect the portfolio's ability to recover. It's not glamorous advice. It's not a viral chart, but it's the kind of boring discipline that actually saves people's retirements. Okay, so here's something that trips people up constantly, and I get why, because it's genuinely confusing if nobody explains it clearly. When people say the market returns 7%, are they talking about the actual number on your account statement, or are they talking about that number after subtracting inflation? Because these are wildly different things, and the internet loves to blur them together in ways that honestly feels almost designed to confuse. The nominal return of the stock market historically has actually been closer to 9 to 10%. The 7% figure people usually quote is the real return, meaning after you've already subtracted inflation, which historically averages around 2 to 3%. So when your buddy tells you, just get 7% and you're golden, ask them, 7% of what? Before or after inflation eats its share? This matters enormously because inflation isn't some background noise you can ignore. It's more like a tax you can't opt out of, quietly nibbling away at your purchasing power every single year, whether you notice it or not. $1 today buys less than $1 did 10 years ago, and it'll buy even less 10 years from now. That's the deal. That's the water we swim in. Here's a small, almost silly way to picture it. Remember when a movie ticket cost like $8 and you thought that was kind of a lot? Now it's 15, maybe more with the fancy recliner seats. Nobody handed you a memo. It just happened, slowly, in the background, while you were living your life. That's inflation's whole personality. Quiet, relentless, easy to underestimate. So when you're calculating your future, how much you'll need to retire, how much that $1 million will actually be worth in 30 years, you have to think in real terms, not just nominal numbers. $1 million in 2055 is not going to feel like $1 million feels today. It might feel more like 300,000, depending on how inflation behaves over those decades. And that's not me trying to scare you, it's math. And it's math that a lot of people conveniently skip because it makes the future look scarier and less tidy. The actionable piece here is simple, if not exactly fun. Always run your projections using real inflation-adjusted returns, not the flashy nominal number. It's less exciting. It won't make for as pretty a chart, but it's honest, and honest is what actually protects you 20 years from now. This one genuinely irritates me, not gonna lie, because it's so preventable and yet so many people just don't check. Let's say you're investing in a fund with a 1% expense ratio. Doesn't sound like much, right? 1%? That's basically nothing. That's like the tip you leave when the service was fine but not great. Except, And here's the part that should genuinely bother you. That 1% isn't a one-time fee. It compounds against you every single year, forever, on your entire balance, not just your contributions. Over 30 or 40 years, the difference between a 1% expense ratio and a 0.1% expense ratio can be the difference between retiring comfortably and retiring not quite comfortably. We're talking potentially hundreds of thousands of dollars over a lifetime, just quietly siphoned off in fees you probably never think about, because they don't show up as a line item you consciously pay. It's not like a bill that arrives in the mail. It's baked in, invisible, almost designed to be forgotten. I think of fees like a slow leak in a tire. You don't notice it day to day. You're driving around, everything seems fine, the tire looks basically full. But over months, that slow leak adds up, and eventually, you're stuck on the side of the road wondering how things went wrong when, really, the warning signs were there the whole time. You just weren't checking the pressure. So here's the actionable bit. Actually, look up the expense ratios on whatever funds you're invested in. It takes like 90 seconds. Low-cost index funds exist specifically because this fee drag is such a well-documented wealth killer, and honestly, for most people, they're the smarter default choice. Not because they're flashy, but because they let that 7%, or whatever the real number ends up being, actually work for you instead of quietly funding someone else's yacht payment. Last big piece, and this one's sneaky in a totally different way. That 7% return everyone talks about, it's usually a pre-tax figure. But depending on what kind of account your money is sitting in, a regular taxable brokerage account, a Roth IRA, a traditional 401k, your actual real-world spendable return can look really different once Uncle Sam takes his cut. Capital gains taxes, dividend taxes, the way withdrawals get taxed in retirement, these aren't small footnotes. They're structural. And the frustrating thing is, most of the popular financial content out there just glosses right over this because your money doubles every 10 years, minus a chunk that varies wildly based on account type, and your future tax bracket doesn't exactly make for a viral thumbnail. This is why account structure matters just as much as the return itself. Money growing in a Roth account, tax-free forever, behaves completely differently from the same dollar amount growing in a taxable account where you're getting nibbled at every year. Same market, same 7%, wildly different outcome depending on the wrapper it's sitting in. The takeaway here isn't go become a tax expert overnight. It's more like understand that the account you're using is not a boring administrative detail. It's actually one of the biggest levers you have. Talk to a professional if you can, or at minimum, understand the basic differences between your account types before you just dump money in wherever's convenient. So, okay, let's zoom back out for a second because I've thrown a lot at you and I want to make sure it lands the way I actually mean it to. The 7% rule isn't a lie. I want to be really clear about that because I don't want you leaving this video thinking the whole thing is a scam or that the stock market is rigged against regular people. It's not. Historically, over long enough time horizons, equities really have delivered strong real returns, and for most people, staying invested over decades remains one of the smartest, most accessible paths to building actual wealth. That part's true. But the number by itself, floating there in a vacuum, without the context of sequence risk, inflation, fees, and taxes, that number is basically a movie trailer. It shows you the exciting parts and conveniently skips the slow, complicated middle where things get messy and human and real. And I think that's the real shift I want you to walk away with today. Not fear, not don't invest, but a kind of clear-eyed respect for how much nuance sits underneath a number that fits so neatly into a headline. Because the people who build real, lasting wealth aren't usually the ones who found some secret formula everyone else missed. They're the ones who understood the boring stuff, the buffers, the fees, the account types, the fact that bad timing happens to real people, and building in some flexibility isn't pessimism, it's maturity, honestly. So if you take one thing from this, let it be this. Keep investing, keep believing in long-term growth, but stop treating a single average as if it's a promise made specifically to you. Build in cushions. Check your fees today, not someday. Understand your account types, and give yourself permission to plan for a slightly messier, more honest version of the future. Because that version, weirdly, is the one that actually sets you free. Anyway, that's what's been living in my head lately. If this made you rethink even one number you've been leaning on, I think that's a pretty good use of the next 10 minutes of your life. Take care of your money, but more importantly, take care of yourself while you're doing it.